Welcome to Candlelight, where price is a mechanical function. I chose to make a two-part video on why waiting is like 99% of what you should be doing as a trader and investor. And part one, I want to be going over why you don't want to be catching or buying strong rallies once they're already, midway. And you don't want to be shorting strong or really weak drops or strong drops to the downside once they're already taking place. You don't want to be buying, what a lot of people perceive to be, I want to buy strength, when price is really rallying hard, and I want to short when price is really falling hard. You want to buy low and sell high. There's a huge misconception where if price is really rallying, you want to, buy strength when you're buying into supply. For price to fall, it has to be high. You can't fall when you're already on the ground. And once price has already fallen a long way, it is highly unlikely for price to continue doing so. 9 times out of 10, anytime you have ballistic movement to the upside or to the downside, price has already finished its move or is about to finish its move and then reverse, mainly because if price moves that quickly, it's essentially a pocket of air. There's no more, if it's falling, it's exhaling. You can only exhale so long. And if it's really rallying hard, you can only inhale so long. Perfect example is GameStop, for example. It rallied really hard and then came back pretty much all the way down to the origin of the move, because the whole rally to the upside is a pocket of air because it's unsustainable. And that's what you don't want to be buying, is that massive rally or shorting a massive drop, again, on both long and short, once it's already in the process. You want to buy low and catch the beginning of that move to the upside, or short high and catch the whole move to the downside. So let's go over what not to do, which is going long or going short moves that have already taken place and are moving ballistically in that direction. And this doesn't matter what markets, or it doesn't matter what markets you're looking at. It works for stocks, futures, currencies, options, crypto, anything. And on this video, I'm going to be going over one example of each for stocks, futures, and currencies. So let's jump right into it. All right, for this example, I'm just going to be going over my daily chart, where here every candlestick, this left-hand chart is a daily, where every candlestick represents 1 day's worth of price action. And this is a platinum futures. So let's go over this rally right here. This is a perfect example where a lot of people think, once you've broken this previous high, so price fell, and then once it breaks above the high, oh, that's a breakout trade. It's going strong. You get a nice ballistic movement out, or nice ballistic movement to the upside. People think you should be buying there, when that's exactly where supply exists, and that's where you start getting an origin of a strong move to the downside. So you want to be buying low and selling high, but let's not go over that. Let's just go over what you should not be doing, which is after price has rallied, that's not where you want to be buying, particularly when price moves ballistically. See these 2 days? Price already moved ballistically. That's the end of the move. Now, granted, there are those few times where price really does continue to go to the moon, but that's an exception. Most of the time, after you have a strong rallying price, and in this case, right after you break above this swing high, a lot of people think that's where you want to buy, when that's exactly where price is going to turn to the downside. Now let's give you a short example where price is really falling short or really falling hard, and you're thinking, okay, I want to short after it's already shown me weakness. So it breaks above this swing low right here, and you're thinking, okay, this is really going to fall, and it falls for another 2 days, but then it comes back out or comes back up, breaks a trend line, and then now you're losing money. You don't want to short after a strong move. That's exactly where the end of the fall is going to take place. Another example is this rally right here, where price broke above this swing high. A lot of people love going long on breakout trades. Right when it breaks out or breaks above, it comes right back down, and you're into negative money again, where that's exactly where you should not be buying. That's where you should be shorting. You should be selling high and buying low. Another example is people wanting to short on On breakdowns, after it breaks just a little bit below this swing low, people are thinking, oh, now it's making, lower lows and then lower lows and lower highs, where that's how you get a downtrend. And of course, that's where weakness is already over, and now you're in strength, you're in demand. So last example, I almost forgot about this one. Here you did have a like a rather significant rally where you should be buying. You should have already been in it. If you're not already in it and you're seeing this massive rally, that's the last thing you want to be buying. And while it looks really tempting, price is going to come back down, because anytime price moves ballistically out of an area, because candlesticks represent speed, any acceleration that is 90 degrees, it's unsustainable. An explosion only lasts for so long. It cannot continue to grow and grow and grow forever. Nothing lasts that long. Populations, any acceleration that is 90 degrees only lasts for a certain period of time. So while it looks tempting, don't buy into it. Don't buy what a lot of people think is showing you strength. You're buying into weakness. So after this massive rally in price, if you already got in low at the bottom of this move, great, and that's when you should be selling high. If you didn't catch that move and you're tempted to go in, again, don't, because this is where the origin of supply exists, and that's when it starts to really come back down. And notice when price comes back down, then it comes into demand, and we'll go over that in the very next video and what you should be doing. And that's where you want to be buying low, and when it's already high, or after price already rallied, that's when you want to be selling high. So that's futures. Let's go over currencies. Right here, for example, price is in a downtrend. You don't want to be, you don't want to be shorting as it continues to fall all the way down here, because that's where demand exists. Now, this you couldn't have known, but you want to be selling at the origin of this move, not when you're halfway down, because that's where you get reversals. For the exact same reason, after this massive rally, which happened, this has got to be a news event. Now, while this is a weekly chart, I'm sorry, I didn't specify that. This is a weekly chart where every candlestick represents 1 week. You don't want to buy when price is really going. Let's just say it breaks above this downtrending trend line right here. People think, oh yeah, I'm going to buy. This is not the move. You want to wait for price to come back down at the origin of that move, and that's something I'm going to be going on in the very next video. But that's where demand is, and that's why you get a bounce. What you don't want to be doing is, after it's rallying, you buy high. You're buying into sell orders or into the short sellers, which is where you should be. You should be selling up here. So after price, or big moves, big ballistic moves where people think, oh, it's really strong, no, you're coming into weakness. You're not buying strength. And like I said, it's a pocket of air. Price moves so quickly, it has no time to give you zones, such as rally base rallies, or a swing low and then it rallies to the upside. There's nothing here. It's a pocket of air, which is why anything that comes up or moves that ballistically, it's unsustainable, and it comes back down the exact same way, all the way down to the origin, where that's where demand exists. So it works on currencies as well. Let's move over to GameStop. Now, this is a daily chart. Every candlestick represents 1 day, and everyone knows, in January we had that huge rally on the GameStop stock, where I'm going to move this forward, because the move was so massive, it scrunches all other candlesticks for this move to be able to fit on the chart. So let's just go back in time, and right now, right here, you're in an uptrend, and you want to be buying low in demand zones right here. So you have 1 and 2. Price never came into it. You could not have known to have caught this move. Another thing I'm going to be talking about in the very next video. So when it really starts to rally hard and just continues to take off and take off and take off all the way to $400, $500, you're thinking, oh, it's really strong, it's going to go to 800. No. Nothing that moves that ballistically lasts forever. It's unsustainable growth. So you don't want to be buying any kind of strong rally, which a lot of people think is strength. You're buying into weakness, and then price comes back down the exact same way, because there's nothing sustaining that move. There's no demand there, because price didn't have time to give you that demand or those origins of large moves, because it was such a large move. The origin is all the way down here because rallies have to start from the bottom and falls have to start from the top. So don't make the mistake of thinking that, oh, I see a really strong move, I need to buy that, or I see a really strong move to the upside, I need to buy that, or I see a really weak move to the downside, I need to short that after it's already been doing it or after it's already been falling. You want to wait for price to come back down into the origins of those moves, both to the upside and downside, and those are the trades you want to be taking. Those are the areas where the imbalance or the largest amount of imbalance of supply being the high side or on top and demand being at the bottom. You want to trade with those orders, with those large stacks of buy orders and those large stacks of sell orders. So this is a short video on what you don't want to be doing and why waiting is so important. Let that rally take place and wait. And then wait for price to also come back into the origin of that large rally or drop. And that's why waiting pays off, because those are the areas where the massive imbalance of buy and sell exists. So I'll be covering what to do on the very next video. Look forward to seeing you guys later. Take it easy.